Hey, also, we just wrapped up this episode on financing. We just wanted to reiterate a couple of things. First of all, not financial advice. Nothing you hear on this podcast is constructed as financial advice. It's just us talking about our experience and opinions on running businesses. And secondly, we're Stripe partners. This podcast is not sponsored by Stripe, and we're not sponsored to promote their products, but FlashQuotes does earn fees through Stripe, including Stripe Capital loans, transactions, payments, and things like that. So for full disclosure, be aware of our relationship with Stripe and take our advice with a grain of salt. Thanks.
Hey all, welcome to the FlashQuotes podcast, the world's best podcast for mobile event businesses and businesses of any type. We are here today to talk about something super interesting on helping supercharge the growth of your business, but it's a nuanced topic. It's not for everybody at every stage, and you might have different feelings about it. And that is financing. How do you bring money to bear to grow your business? When is the right time? When is the wrong time? What are the options available to you? What are some of the best practices? What are some of the pitfalls you should avoid? And just fully exploring that topic. Before we get into it, a little disclaimer. We are not financial professionals or professional advisors, so use our insights at your own risk. We think they'll be helpful, but always check with somebody else who's willing to take the liability, because we are not. We are just here to share the insights. So, with that, maybe let's just talk about some of the different options that people use for credit. Just as a kind of a general lay of the land, you've got small business loans that are very involved. They can take multiple weeks, a lot of due diligence from banks. It's a much more formal process. It's probably something that's very scary to people, maybe something that you've thought about, maybe not. And if you've thought about it, you might have thought, that's not for me. I'm not even worthy of that sort of thing. On the whole other side of the spectrum, you've got people using personal credit cards and just putting things on credit. They might have a high APR, annual percentage rate, that you're incurring as a part of that if you maintain balances on that. And then you've got kind of the universe of things in between. And then you've got different funding mechanisms. You could think about funding your business in different ways. You could think about bootstrapping it and paying for everything out of pocket from the get-go and continuing that way. You could think about venture capital funding, kind of the whole gamut. So Zach, maybe we go to you first. I know you've worked at a couple different startups, some that are VC. You have some perspective on businesses you've started, including FlashQuotes. Maybe you can talk to us about some of the funding avenues you've seen for businesses and what's worked, what hasn't worked, and where your head is with.
Yeah, for sure. It's interesting. How you think about funding and debt and, these options is a very personal thing for founders. Different people have very strong opinions about it. And so, we're here to just offer our perspective and see if it's helpful to you. I know some business owners will adamantly say, like, all debt is bad. I don't want any kind of debt on my business. And I choose to operate in a way that I will only ever use the cash flows and the profits from the business itself to grow it. And that's just aligned with my values and philosophy. That's great. That's fine. There's other people who say more like debt is a tool. If I have an opportunity to, or debt, and I use the word debt because we're mostly going to be talking today, I think, about financing options that would be categorized as debt, but there's also investment capital, right? The two different mechanisms to get other people's money into your business to help you grow in exchange for something, either equity or repayment with interest. So ultimately it comes down to you as a business owner to decide, like, what do I want from this business? Am I trying to grow? How aggressively am I trying to grow, and what trade-offs am I willing to make in order to grow this business quickly or just to unlock new opportunities that wouldn't be available to me otherwise. Like, I'm curious to kick it over to you, Justin, in a second and hear about opportunities where you've seen, like, maybe to launch a new city or to finance a new cart or to do big changes in the business, and the revenue that it can generate sometimes requires more startup capital than you can realistically pull out of just the gross the the bottom line of the business. So yeah, there's a spectrum. You can operate a really great business without ever taking on any loans or investment. You can operate a great business that's fully funded by investors or an SBA loan, and start it entirely with none of your own money, or you can use debt or investment as a tool situationally achieve a specific goal or a specific growth target that might have been out of reach. And so I think those are the kind of the spectrum of options that people have, and I think we just want to illuminate each of them a little bit more so that people can decide what works best for them and their business.
Yeah, and I think, for small event-based businesses like ours, I think the most common ones are just, personal credit card, loan from friends or family, or a business partnership that is born primarily out of not the skill set of the founders, but just financial need. And I have always, kind of hated that idea. And business partnerships are very, very, very much like marriage, and you should take them with the same weight. Zach and Daniel are probably some of the only people in the world I would ever partner with in a business, because we go way, way, way back. Like, I've known these guys decades. We've seen each other in all sorts of environments and circumstances, and traveled the world together, and been in stressful situations, and, Christian rock bands in high school. And we've just seen it all and been through it all together. And these guys represent, yeah, just a very, very small number of people I'd ever consider it with. Sometimes people will go into business just specifically like, okay, let's pool our money. But then, there's not really any trust or rapport of any significant length. And that, I don't know, that makes me uncomfortable. It's not something I would do. Some people, it turns out okay with, but a lot of times business partnerships fail when the rubber really meets the road. So trying to have a business partnership where the primary driver is just the financial piece without the skill set and kind of compatibility and vision could be a recipe for disaster. And there's definitely some war stories about that. Actually, I know Nikki from Inacho has one that she was sharing on social media that I'd love to maybe dig into at one point. There's these interesting statistics that I wanted to cover that actually Stripe provides on just online, and they took a poll of small business owners, and according to them, 63% of small businesses in the U.S. say that they aren't able to get access to all of the financing that they need. And then, lending by traditional banks is really challenging. According to Stripe, 68% of small business owners think that their current bank doesn't understand their business. And I think that's even more true for event-based businesses like ours, where demand, we're not a cafe with super predictable income. And so I think that percentage is probably even higher with event-based businesses, and us feeling like banks don't understand us. It can be hard to get a more traditional business loan from them. And then the other statistic is that 76% of small business owners use a personal credit card for business expenses. I know I did. And that became a bottleneck for me. Financing became a bottleneck for me because I don't like to start new locations small. Or too small, because there's this strange, almost chicken and egg thing that can happen when you start a coffee cart or event business. And if you just start with one cart, you have a very limited output, and you can't do multiple events per day. And because we're in the events-based business, we have these crazy seasonal highs where multiple carts can dramatically increase your revenue, but it does cost more to start. I've never started a new city with less than 4 carts, and between the warehouse organization and equipment and the carts, I mean, it might be 50 to 60 to 80,000 for us, if not more, to start a new headquarters. And so, that's not, especially early on, that wasn't just money I had laying around. And so I needed some way to get that money, because I knew if I could do that, I could grow much faster and really overtake the dozen or more single cart operators that are in the city that just can't serve multiple events per day, can't accommodate large crowds and conferences and conventions very well. So, I started a while back. Actually, I'll I'll pause there, but I eventually did find a source of financing that I was really happy with, that worked well for for me, and that I was comfortable with. I had people in my life who were willing to loan me significant sums of money, but I just, we're talking. I could probably make a call right now and get like a couple 100,000 in my account, but these are from friends, and I don't want, these like financial strings hanging over our like personal friendships. And so I really want to keep those friendships really nice and clean, not have this weight of, debt and things hanging over them. So I've found some other ways that I was much more comfortable with, and that has really been the tool and mechanisms we've used to grow for the last few years, because we have 57 carts now. That's like over $500,000 in coffee carts, which is a lot when you add it all up. And it was challenging to learn how to do that, and navigate through cash crunches of slow periods and all that sort of stuff.
Maybe before we jump into that, where you've landed, so we're going to keep people hooked, with bated breath on whatever that is. Can you take us back? Started in 2017, farmers markets, one cart, kind of had a mental shift, started thinking about growing. When did you said in the beginning some personal credit cards that you maybe put a big charge on and you had to pay it off over time. Do you remember kind of contemplating that? Was that easy for you? Like, or did you have apprehension where you thought, like even just having this card balance that I'm paying off, I don't know if I'm going to be able to do it. I'm scared to buy this second or third cart because it's not going to make sense. Or did you have a feeling of the numbers such that you were totally comfortable doing that? And was that a good starting point early on? Like, would you still say there's a place for that, or you could skip that with some of the tools that are available?
I mean, that's a personal choice. It kind of just depends on where you are. A lot of times these inflection points are when you have a large event that you can't service yet, right? You need more carts or more equipment to service this event, or so it could be like, okay, if I get this booking, this could be a $10,000 booking. It could pay for a new cart or a new machine, but I need that machine now, and I need it ready, and I need it pay for it before I get paid. So that might be an opportunity to just throw it on early on. Definitely, I'll just throw it on a personal credit card. It's fine. I know I've got another big check from this event coming in, and probably won't have to ride that balance very long. And so it was usually like that, and it was usually at these inflection points where I had large invoices, so I knew I had some money that would be coming in, but I didn't have it yet, and I needed the equipment immediately.
So you had pretty good line of sight to some payday in the future, such that you felt pretty comfortable doing that. One thing I want to drill in on a little bit that you said, which I think is a really good insight. It's not directly related, but it's somewhat related, which is because of the seasonal nature of a lot of event businesses, you have to be comfortable having, like for certain parts of the year, having way too many resources that are sitting idle. Because if you don't get comfortable with that, you miss the other parts of the season where those are fully booked. And you almost need to, you have to actually have sufficient resources to like service the peaks. I mean, hopefully at the peaks you're fully rocking and they're all being used. But if you're too scared to have those idle resources in the downtime, you're going to miss out on the upside in the peaks, and really your average sales are going to suffer as a relationship.
100%.
What I was trying to think of there as a consequence of that.
That's so true, Daniel. And I'm guilty of that still to this day, because I know in one of my cities, it felt like during certain parts of the year, the summer, like I have way too many carts sitting idle. And because of that, then I wasn't willing to add more to the city during the peak times, because I thought, actually, these 4 carts will make me more money if they're in this other city. So I don't want to add them to city 1, right? They're going to make me more money in city 2. But as a result, I didn't have the bandwidth. And so in city 1, I see competitors growing, right? They're filling some of the gaps, and I had left that margin in that room, and I didn't have enough carts, and was fully booked like 5 to 6 days a week for these busy periods with every single cart. And then, sure enough, there's room in the market, and that now competitors, I see them on social media, they're adding new carts, and I'm like, that could have been me, right? Like I could have just had more carts to service the demand, but because I wasn't comfortable having those carts sit idle during the slower season, here we are with competitors gaining really good traction. That could have been my.
Yeah, that's fascinating. Because how much is a cart set up for you to kind of get going? Zero, like nothing to this cart's ready to go. 10K or something? Or
Yeah, I think around 10 to 12. I haven't reran the numbers in a while, and we've made some tweaks, but I think around 10 to 12. And
10
that's
to 12. And then like you think about your average event, like the profit you get from an average event. I mean, how much utilization in a year does a cart have to have before it breaks even with its costs, right? It seems like that's kind of the way to think about it.
yeah. Yeah, it's not too much really. I mean, not too much at all. It probably
Yeah.
needs to see like 20 events in a year probably to break even.
I heard an interesting anecdote of there's a guy on Twitter I follow, Michael Girdley. He's kind of a serial entrepreneur, but he owns a fireworks business, and fireworks is the most seasonal business there can possibly be in the U.S. Right? He literally like the business is they do like 99% of their sales on 4th of July weekend and New Year's Eve weekend. And that's it. And they need to be able to finance and pay for, and a warehouse space and pre-order, all their inventory right before those 2 weekends or whatever. So they don't, so they actually have tons of fireworks to sell before they actually make any money. Right. And it's just kind of a crazy, crazy concept. He's talked about that before. If you want like the most extreme version of how do you manage the finances and talking to banks about a business that literally basically is open 4 days a year and needs to be able to like fund the entire next year plus of all of its profits from 2 weekends of work. It's
That's
pretty wild.
crazy. I didn't even
Yeah.
that yeah, that's wild. I'd never even thought about that as I thought I had it bad or we had it bad seasonal event business. That is bonkers.
Cool. So then talk us through, Justin. You said, okay, I discovered this new financing option that has worked really well for Good Hard Coffee. I think you've used it predominantly in expanding. If we go back to our levels of growth, kind of this level 4 to level 5, expanding to new cities that are taking a large capital investment to do that. Tell us about what that is, how you discovered it, and how you've used it.
Well, one day I was just in my Stripe account and bing, I see this little banner. It's like, oh, you're eligible for Stripe Capital. I'm like, oh, what's that? And I go in and look at it, and it's like, oh yeah, you can, we're offering you this much. You can cut. There's like a slider, and they give you a max amount, and you can choose what amount you want up to the max, and then as that slider goes up or down, you basically repay this loan as a percentage of all incoming transactions. So they have all your transaction data. If you use Stripe, they know what your processing volume is, and they run the math and determine like, oh, we'll loan this company this much, and we'll take a percentage of every future transaction for payback, and and it's a fixed fee. It can be a little higher of a fee than like a traditional business loan, but the process is crazy. Just literally, I think my first one was for like $18,000 or something. A few years ago, $18,000. I just selected the amount. Okay, I thought through. Okay, I needed like 2 carts or whatever it was. I don't remember the equipment, but selected the amount, and I think I settled around like, oh, this amount for my processing volume and this offer, I'll have to pay like 10% of my, of all transaction volume to repay this. And over, whatever it was, a few months at the time. And I started small and I tried it. I was like, wow, that was cool. Like I got approved in I think like less than 24 hours. It could take up to a couple days, but I think it was less than 24 hours. And then boom, that money was in my account within a few days, and it was just really seamless, frictionless process. I was kind of shocked how easy it was, and I've continued to do that. I've literally like got one after the other, and I'm probably not really ever had a period since then where I don't have some loan going through Stripe Capital, because that's how we've largely fueled our expansion. What I like about it, like I said, it is more expensive than a traditional bank loan, but the friction is zero. And in a traditional bank loan, you will generally have just a flat monthly payment that you have, regardless of how much you have coming in. What I like about the Stripe Capital is that it fluctuates, and it takes a percentage of my incoming revenue, but that means that during busy periods, I'm paying that loan off faster, and then during slow periods where my revenue is lower, it's still only taking that small percentage. And so I think it works nicely for me, like psychologically, just by personality and psychologically, I like it. It's not for everyone. Some people may prefer traditional routes, but I've liked it, and it's been really what's fueled our expansion. And yeah, it's been incredible for me and for GoodHeart.
Do you recall what the fee is, or like the ballpark of, on an $18,000 loan, like what's the fee that would go with that?
Well, I forget. I think it was and it can change, right, based on like the economy, right, and what what the interest rates are broadly. So it has fluctuated a little bit. I believe it was around like a 10% flat fee on the loan. So or maybe 8 to 10% on that first one. It may be a little higher now because, lending is more expensive right now than it was a few years ago. So, it was a fixed fee, I think, around that percentage. I don't quote me on that.
And what Stripe does, and a lot of these do, is they'll give you a fixed amount. So instead of making it obscure, it's a percentage, I have to do some mental math or figure it out. They basically say, hey, we'll give you this, and over the course of your loan, you got to pay us, if it was 8% on 18,000, quick math, like 9,600 or something, no, that's not the right math, but something like that. 18.
18, it would be like $1,800, right? Like,
Yeah. 1,800 would be the tens. That's really, really cool. I mean, I think you can't really discount how interesting this concept is for these merchant processors, because before it just used to be, hey, I've got this full small business loan, or I'm putting it on my personal credit card. Really, the big challenges when you're loaning money is, how credit worthy is this person? Like, how do I make sure I loan them the right amount that they are well equipped to pay back? And then what's the mechanism through which they'll pay it back? And it's such a good idea to be able to look at the historical transactions from a merchant processor, GoodHeart Coffee, inbound payments. If there's a long time span of very consistent growing transaction volume, that is an amazing indicator of exactly how much they can offer, your credit worthiness, your ability to pay it back. And then all of the payments are flowing through that processor like Stripe before they go to your bank account. So there's the mechanism through which they can take that 10% or whatever the payback amount that you've put in is. So that is, that's super, super cool. Very, very exciting functionality. And I know a lot of these, like Square, Shopify, like different services also have these sorts of mechanisms. So if you're not using Stripe, that's available to you as well. Zach, I know you found this white paper that was digging into this and kind of exposing some of these Stripe Capital features. Can you talk about any other items that were really jumping out to you here?
I mean, there was another statistic in that white paper from Stripe. On average, SMBs, small, medium sized businesses, only have 27 days of cash on hand. And traditional financing options can be slow and unreliable. It can take you months to secure a loan. So I think that's another thing that's appealing about Stripe Capital for people in the event space. Like Justin said, not only is the repayment schedule based on how much income your business is making and can ebb and flow with your seasonality, but it can also be super fast. If you get a booking today for this weekend for 4 carts, and it's a huge booking, but you need instant access to capital to go get your stuff together. Seems like Stripe could probably connect you with the funds to get rolling much faster than going and talking to a bank, or making some phone calls and applying for a traditional loan. So that's a really interesting aspect too, that you can be very nimble and get access to the funds kind of on demand when you need them.
Yeah, nice. So for us, this is kind of impacting things that we can offer within Flash Quotes and some of the product strategy going forward and some features we're aiming to release here pretty soon.
Yeah, so we're not obviously sponsored by Stripe on this podcast, but we do work closely with Stripe at Flash Quotes. Every single Flash Quotes user is using Stripe as their payment processor under the hood to get paid. And Stripe has been reaching out to us about opportunities to get some of these, make it easier for Flash Quotes users to get access to some of this stuff. So we will be maybe by the time you listen to this, we will be rolling out a couple new pages in Flash Quotes to help you see what options you have available through Stripe Capital. There will be the option to view offers that they have for you for your business to see if you want to accept a loan from Stripe, and what like Justin said, the slider of choosing how much you want and what percentage of your transactions they'll take to pay it back. That will be something that you can do inside of Flash Quotes instead of having to go through Stripe to do that. And the other thing that they offer that's pretty cool is instant payout or instant, what are they? They're called payouts. Yeah. Instant payouts. So anyone who's been using Stripe for a while, you accumulate a balance, and then based on the schedule that you have set up, it may take a few days or a week or what, how it's configurable in Stripe, but there's some period of time before that money hits your bank account where it's sitting in your Stripe balance, and then it gets paid out a few days later. Stripe has the ability to do instant payouts. So if there's a particularly, for whatever reason, for cash flow reasons, you need to accelerate the payout time to your bank account, they have the ability to do that for a fee. And they have an option that we can add that to Flash Quotes as well. So in the near future, you'll be able to see your payout schedule when all the balances are going to hit your bank account. And if you want to accelerate one of them for a small fee, you'll be able to do that all right within Flash Quotes to kind of manage your full financial picture. So that's kind of the goal, right? And that seems to be Stripe's vision, which I think is really smart, and it's great for us at Flash Quotes. Is they want to make all of these financing and payments, financing, credit cards, etc., all accessible through the tools that you're already using every day, rather than having to go into the Stripe dashboard to do it. I know a lot of Flash Quotes users log into Stripe once and then never do it again because it's just not something they're used to using. So they're making it easier and easier for the software platforms that you use every day to kind of tie in that stuff and just present it to you right in the place where you're already doing your work. So that's our vision for Flash Quotes as well. That's why we like working with Stripe, is we want it to be the one-stop shop for running your business and to have visibility into your cash flow and your payments and your invoices all in one place. This seems like a no-brainer to add this for our users.
Yep, 100%.
Nice. So Justin, if people go into their dashboard and they've got, loan available to them, there's the slider on the amount. You can adjust, how much you pay back from your future revenue. What would be some questions you'd be asking yourself as to whether it makes sense to take this on?
Well, I think, do you need it? Are you turning away events? That's the number one, I think, test for me, is like, during busy periods of the year, are you turning away events? And if so, then that means you're leaving revenue on the table. I mean, I really only take on these loans so that I can build more carts and build more income generating assets. And so, in my opinion, it shouldn't be to build out a fancy office or whatever, do this or that. It's very much, and it's always been for me, use this because I'm turning away events and I want to build more income producing assets that will then help me pay back faster and that. So that's really how I use it. I know, especially early on, when I didn't really understand the seasonal cycles of, the busy season, the slow seasons, the best time to be expanding and building out your carts and prepping for growth is during the slow seasons, but that is when your income is the lowest. And so it can be kind of scary to have these huge outflows of cash in a really slow part of the year, especially with the economic uncertainty that, that we've faced a little bit this year with tariffs and the political climate. It does seem like corporate spending across the board has been down, retail spending is down. And so, I'm optimistic in that, it's going to be a great, at least a solid Q3 and Q4. But that's how I like to use it, as kind of a cushion, so that I can actually make these large purchases and grow and prep during the slow season when cash flow is the lowest. And that can, even though I know it's coming every year, it's kind of psychologically scary. So it's just really nice to have that buffer as well for psychological comfort, so you as the business owner can sleep well. We have definitely had, we have been in a cash crunch before, and it is a terrible feeling where my growth and expansion was a little too aggressive and a little too bootstrapped, and I was puckered up, laying in bed every night, stressed out, and it was not fun. And so just being able to do that a little more strategically with a little more cushion can be really nice. So
How do you think about like, do you do any math on like payback period? How many events would this card have to serve to pay itself off? Or how, ROI calculations on this capital that you're deploying, and what the return could be over time? Or is it more just kind of a gut feel of how many events you think, more based on your leads and your incoming interest? Because there's also this question of like, how many carts can my city sustain, right? There's not an infinite number of carts that you can buy and build and still have demand for them. So how do you figure out like the right number that you need for your business based on the opportunity and that kind of thing?
I mean, I'm not, a financial analyst. I'm not an accountant. I don't get crazy fancy with that stuff. It's more just like, have I turned away a total of 3 to 5 events or more in the last busy season? If so, that's, depending on your average order value, that could have been $5,000, $3,000 to $5,000 if you turned away 3 to 5 events. If it's more than that, then it's a no-brainer. And that's probably only if busy season is usually kind of one quarter. So if you are turning away 3 to 5 events in any given quarter, then you maybe should consider adding a cart, depending on your average order value and the cost to build the cart. Like I said, the repayment period is not super long on these carts if you're actually having leads and bookings. And, some of the ones you could turn away could be large. It could only take one, right? One turned away event that was 5,000 or more, multi-day conference. So yeah, that's the primary driver, is just how many events have we had to turn away due to being fully booked. That I start to think about it at that point.
How do you keep track of that?
Well, it's easy when you're a little bit smaller because you're the one doing sales. And so it's kind of just either you could track it somewhere. These days, it's a little bit more of me just talking to my event planners and kind of their sense. I talk to my operations person, my event planner, and we just kind of reflect after any given busy period, like, do we need more carts? Can we sustain more carts? And the answer is pretty much always yes. If after you've gone through a full year with your current, for us, oftentimes after we've gone a full year with a current, a given cart count, almost always, we've continued to grow year over year in basically every city. So it's almost always a no-brainer that, yeah, we should be adding at least a couple more carts to each city year over year.
So for you, busy season is, and a lot of people in the coffee world, Q4. And so kind of January, February is like a reflection on the prior year to say, how did things look? What's the feeling from the team, especially on this last quarter on events we had to turn down due to lack of capacity?
Yeah. And May. I mean, May and December are the busiest months. So it kind of ramps up from January to May, takes a dive, ramps up from August to December, takes a dive, generally speaking. So we kind of have 2 busy periods per year, and yeah, consider and reflect after each one if we feel like more carts could be supported. That's all I've got. Let us know in the comments if you have any other questions. I'm sure this probably got the wheels turning for a lot of you as you all look to grow and expand. I know a lot of FlashQuotes users are growing and expanding, and how to fund that becomes a very important question.
Yeah. I think the actionable takeaway, if I was listening to this, would be if I'm currently putting business expenses on my personal credit card, I should today go look and see if I could get, a Stripe Capital loan or something else that's lower interest rate, right? Because your credit card is most likely 20+% APR. So unless you're able to pay that off every single month, look for less expensive capital that you can put into the business. And this is a great option. There are other options. Just explore it, see what's out there. That's something that, I don't know. I hope this is helpful to people because not everyone has a finance brain. Not everyone has an MBA like Daniel. So just some practical tips on efficient use of capital in your business is hopefully helpful for people.
Except I can't even do math, dude. Like,
yeah,
I just literally said I've been embarrassed since then. Like I said, like $9,000 and 18,000. Like, what the heck is going on?
Never do public math. Never do it.
Never do public math. This is be warned, people. Oh my gosh, come on, baby. 1,800. Work back a couple hundred. Just chill out. 16. Okay, 1620. 1620. Let's go. The other takeaway is pay attention to your capacity. Right, like you may not know you need more carts. You may be afraid, you may be apprehensive to grow your capacity, but this is a potential tool on financing that might be cheaper than you thought, might be easier, might be faster, might have a payback mechanism that you don't have to think about as a business owner. The last thing you want to do is think about one more logistical thing on paying back. This is all automated. So that's another good thing to think about too.
Yeah, and one larger rule of thumb, because I'm talking, the time to pay back the expense of a cart, we've talked about in a little more micro terms, but it does seem to be some larger rule of thumb that each cart, because if I look across all my cities based on, our revenue and the number of carts we have and all this, each cart does seem like it can generate about $1,000 in sales per year. Now, you could do more than that if you're a single cart operator. But between, the seasonal ups and downs and, the high demand periods, low demand periods, different days of the week, like it does seem like once you get around $100K per cart, inherently you need another one because all the demand is going to be on a date where that cart is already booked. And so that's kind of a larger rule of thumb is if, you're finding yourself hitting these revenue points, 300K, 400K a year, you're probably starting to feel that, right? You're probably also turning away events, but that's just one other broad stroke that you could kind of use to calibrate and decide, okay, I'm at, 300-400K a year. I've got 2 carts. I'm turning away events. Yeah, it's probably time to add another cart or 2.
One other takeaway, I think, Justin, that you said that is worth reiterating is like, what should you use this capital for? I think it was really wise to say it should only be used for income generating assets or growth. I could also imagine maybe not so much in coffee carts, but in other businesses, for example, it could be used for advertising or marketing or other expense, things that widen the funnel and bring in more leads, more bookings, more revenue to the bottom line of the business. Those are the only things that are probably worthy, in our view, of some sort of financing, because everything below the line, like overhead, your softwares and your accountants and your offices and things like that are just sort of the cost of doing businesses. They should always be funded by the profit of the business, right? Otherwise, you don't have a profitable business. So you need to make sure that there's margin and that all of that stuff is kind of the budget that you have for those types of expenses is driven by your revenue and what profit you want to generate, not by taking on financing. The financing is really a tool to expand the pie and grow the top part of the business.
Yeah.
Love it.
That's how we use it.
Mm-hmm.
Show me the money. Never do public math.
Yep.
That's hilarious. I'm going to put that on a shirt. All right. Thanks, everybody, for hanging out. Hope this was helpful. Hit us up in the comments on YouTube or wherever else you can find us. And we'll be back next week with something else tasty.
Ciao.